In this week's video, we'll review the latest S&P 500 charts using multiple time frames to help us answer the question, will steel tariffs end the bull market in stocks? In the slides that follow, we'll be focusing on this portion of the familiar Jesse Livermore quote. The big money was not made in the individual fluctuations, but in the main movements, that is, not reading the tape, but sizing up the entire market and its trend. All things being equal in the markets, we're better off simplifying relative to trying to make things more complex. We'll also simplify things using the three basic market types, and we'll apply them to the present day. In the first segment of the video, we'll be focusing on the long-term trend. And at the end of the video, we'll shift gears to the short and intermediate term trends. It's often helpful to go back and revisit charts and indicators that you've looked at in the past to see if we can learn anything new about the present day market's risk-reward profile. It's a busy looking chart here, but we'll walk through it piece by piece. This is the S&P 500 here. This is a monthly chart dating back to 1992, and it goes into calendar year 1995 on the right side of your screen. Clients and regular viewers may remember that when the Bollinger Bandwidth gets low on a relative basis relative to looking backwards in time, it basically tells us we have one of those sleepy, trendless consolidation type markets. And the bullish Bollinger Band squeeze signal comes when the Bollinger Bandwidth starts to rise from low levels. And then the second part, or the confirmation, is when you get a price surge and price closes above the upper Bollinger Band here, which is exactly what happened at the end of February 1995. This is known as your price surge. The squeeze relates to the distance between these bands, or the fact that the Bollinger Band width is very, very low on a relative basis. And if we take a step back, we can understand what low on a relative basis means. When we look backwards from 1995 at the recent past, the Bollinger Bandwidth was very, very low. The same can be said for the turn that occurred in 2016. When we look backwards, this is a very, very low level relative to all of these levels. And once again, in 2016, we had that sleepy, trendless type market on this time frame. Very, very similar to 1995. Our squeeze is a little bit more noticeable here. The Bollinger Bands literally are squeezing price here. We're open to a move when the Bollinger Bandwidth starts to rise from very low levels. And then we get the quote-unquote confirmation that a new trend has started when we get the price surge, which occurred. We could see it, measure it, and put it in a model at the end of February 2017. We've been referencing this sleepy look for some time, including back on November 30th, 2016, via this See It Market article. You should be able to find it by Googling this title here. If you're new to these videos, it's also helpful to know that Bollinger Bandwidth and all of these signals that we're talking about have been very, very helpful. Since the end of February 2017, a year ago looked very, very similar to the end of February 1995, in terms of our long-term expectations or understanding the realm of possibilities, it might be helpful to know what happened after point A here, which is very, very similar to the end of February 2017, or roughly 1 year ago. So when we flip over, here's point A. Here's the same point A here. This is the S&P 500 in 1995. This point A is when we got the price surge at the end of February 1995, which is very similar to a year ago. And after the price surge or the confirmation occurred, good things happened for a long period of time. the S&P 500 rallied for an additional 1,851 calendar days and tacked on 213%. If, I can't emphasize enough the term if we saw a similar move from the similar chart pattern that we had roughly a year ago, it's difficult to comprehend this when the S&P 500 in February or early March of 2018 is trading at 2685. If we had a similar outcome from this point here, the S&P 500 would rally all the way to 7407, and the rally wouldn't end until March of 2022. It's not a prediction in any way. It just helps us understand the realm of possibilities. If we know that markets can go up for 5 years and gain over 200%, it gets much, much easier to understand longer-term outcomes relative to shorter-term and 100% to be expected volatility. And if seeing the S&P 500 reach 7407 by 2022 seems ridiculous, that's basically the same move in magnitude and duration that occurred after the similar looking period in 1995. So this is where the price surge occurred on February 28th, 1995. This is the S&P 500 monthly. And this is where our price surge, where we closed above the monthly upper Bollinger Band on February 28th, 2017, occurred about a year ago. If we look backwards from these points, what can we learn? Well, number one, both periods had come out of a relatively long-term consolidation box because this is a monthly chart. This box dates back to 2014, and this box here, before the breakout in 1995, dates back to 1993-ish. But we can also make an argument the present-day setup is better than the setup in 1995. Why? At this point in 1995, we're a long way from this base here. In the present day, we're much, much closer to a much more constructive and longer term base. This is roughly a 7-year period in here. This base on the S&P 500 spans from the mid to late 1990s, and price didn't break out of the box until 2013. The longer a market goes sideways, the bigger the move we can expect to get. This period is much, much longer than this period here, and we're much, much closer to the base in the present day than we were here, telling us not only is it in the realm of possibility that the S&P 500 could go to 7407 by 2022, but it's also in the realm of possibility that the rally could last longer from a duration perspective and could go further from a magnitude perspective. It's even better if we do the same look back for the NASDAQ. This is when the S&P 500 had the price surge confirmation signal here on February 28th, 1995. This is where the S&P 500 had the similar signal on February 28th, 2017. In this case, we're only looking back 18 years because the NASDAQ doesn't come into play until 1978, so we'll compare apples to apples. Similar situation here. Before the price surge confirmation comes, we've got a consolidation box. But that's really where the similarities end. The NASDAQ is breaking out of an extremely long-term consolidation box, much, much longer than this consolidation box. And for the NASDAQ, the breakout occurred here and was retested basically in 2016. And we can draw a horizontal line from price in 2016 back to the peak in 2000. The longer a market goes sideways, tells us to keep an open mind about much better than expected outcomes in terms of it being in the realm of possibility. These are all probabilistic statements based on the facts that we have in front of us. If the facts change, then our assessment of the probabilities will change as well. Since it doesn't do us much good today to compare something that happened a year ago, let's fast forward in the 1994-1995 example and see what we can learn. So this point here, a year ago in 2017, is very, very similar to this point here in early 1995. A couple of things jump off the page. We get the confirmation signal, price stays above the upper Bollinger Band, eventually comes back in, and then clears it, stays above it for 1 month, and then pops back in. This is January 2nd, 1997. The look of this purple box here and the look from here to here is very, very similar to the present day. We get the price surge. Eventually, we come back below the upper Bollinger Band. Then we exceed it, close above it for 1 month, and then come down to the present day. This is being recorded on March 1st, 2018. In terms of what we can learn from the fact that price recently, in the very, very recent past, was able to close on a monthly basis above the Bollinger Band from stockcharts.com. On the face of it, a move to the upper band shows strength, while a sharp move to the lower band shows weakness. We don't have anything moving towards the lower band, and this is a sign of strength. According to stockcharts.com, when we use momentum oscillators, it takes strength to reach overbought levels, and overbought conditions can extend in a strong uptrend. We've talked about that a lot. Overbought does not necessarily mean bearish. Similarly, prices can walk the band with numerous touches during a strong uptrend. Net bottom line, this is a sign of strength, not necessarily a sign of concern. So in the 1995-1997 example, what can we learn if we walk forward from this point? Which helps us understand what's a realistic expectation if the strong trends remain in place walking forward from the present day. So this purple box here on March 1st, 2018, the second move above the upper Bollinger Band is very, very similar to this purple box here in late 1996, early 1997. And in both cases, we closed above and exceeded the upper Bollinger Band. That was true in late 1996, early 1997, and it's true in March of 2018. Back to stockcharts.com. It takes a pretty strong price move to exceed the upper band. Just as a strong uptrend produces numerous upper band tags, it is also common for prices never to reach the lower band during an uptrend. Strong uptrend is tagging the upper Bollinger Band. The strong uptrend never reaches the lower Bollinger Band. So the point of the exercise here, this point in here is similar to March 1st, 2018. What can we learn potentially about what the market will look like going forward? Which helps us better understand a wide range of outcomes and probabilities. We are not forecasting. We started looking at the similarities between these periods as far back as November of 2016. So far, the script is playing out as anticipated. So as long as that's the case, we'll continue to study it and see what we can learn. By no means are we trying to imply that the next 5 years will look identical to this period here, but it could look similar from a trend and volatility perspective. Therefore, what looks different on the right side of this chart relative to what we've just been through? What jumps off the page is higher volatility, Going forward, this arrow is similar to the present day or March of 2018. A reasonable expectation is that volatility will pick up, and that aligns with common sense. This is a very easy looking, very, very strong trend. Easy markets are followed by harder markets. It's not realistic to think that volatility on a monthly basis is going to remain this low for 5 to 7 years. Back in 2017, we said it's highly unlikely that 2018 will be as easy as 2017 from a psychological perspective. I think it's pretty fair to say that's true year to date. 2018 has been much more volatile. History tells us that's normal, and we should be prepared for a more difficult psychological environment going forward. Realistic expectations can help us prepare in advance to deal with these challenges. One of the ways that we can deal with these challenges is to manage based on our cost basis rather than managing versus your high watermark. Here's the thought process. In late January 2018, my account just hit $800,000. It's never been that high before. When the market pulls back 10%, you're disappointed. Versus if we manage our expectations based on our cost or our basis or our entry points. Let's walk through a historical example and then let's tie it to the present day and our actual accounts. Let's assume here we get the signal in early 1995, so let's assume after the breakout that we scale into the S&P 500 at 475, 485, here's the axis here labeled, and at 510. If we use this as our reference point, when the market pulls back here to 640, that's still well above our cost basis, and the same can be said for every one of these pullbacks. So if my average cost basis is 485, and right here we pull back to 640, at the low, the monthly low here, I still have a gain of 32%. When we pull back to 730, at the worst point, I still, relative to my entry point, have a gain of 50%. And if we do that all the way up, our average gain relative to our cost basis between point A and point B here during the pullbacks and at the monthly low is roughly 93%. Why is that important? It's pretty easy to withstand a 10% pullback when you had a 40% gain and now you have a 30% gain. That's quite a bit different than having a 3% gain, a 10% pullback that turns the 3% gain into a 7% loss. So keeping our low cost basis, if possible, can greatly assist us relative to the more difficult psychological challenges that are most likely ahead, and can assist us greatly with dealing with what we expect to be harder markets with higher volatility going forward, even under a very bullish and favorable long-term outcome. If we're measuring our success relative to our original cost basis rather than our high watermark or our account balance, it's much, much easier to maintain the proper perspective relative to a constructive, bigger picture or longer term outlook. Said another way, focusing on our cost, our basis, and or our entry point helps us keep our eye on the prize, what our goal is. Our goal, as we've stated many times in these videos, is to navigate between a point A and a point B that could be several years down the road. Once again, not a forecast. Everything that we have in front of us today says this is still within the realm of possibility. There's plenty of volatility between point A and point B, meaning volatility in the present day does not negate any of the long-term data and facts that we have in hand. Could the data at some point negate this type of outlook? Absolutely, positively, yes. That's where maximum flexibility comes in. As long as the data we have in hand supports this type of possibility or outcome, we will continue to keep it within the realm of reason and manage against it. A 10% pullback or even a 20% bear market really doesn't look that bad in the context of a 213% gain. This is the prize. The present day setups tell us that the prize could still be several years down the road. Obviously, all of this is theoretical, but we can tie these concepts into our actual cost basis, our actual early entry points, and the present day, demonstrating that the psychological impact of a correction is highly dependent on your cost basis. Clients that have been with us for some time, obviously, we can't have an entry point in 2016 for a client that came on board in 2018. So if you're a new client, keep that in mind. When the hard data started to turn in a positive manner, we started to scale into SPY positions. If we look at our history file on Schwab, these numbers are going to be a little bit different because we've adjusted these numbers for dividends, which helps us understand total return, which, as we covered last week, that's what we care about. So our actual adjusted cost basis for dividends. Entry point number 1 for SPY in this area here, 200. Entry point number 2, 201.57, 3, 204.56. How does that help us maintain perspective regarding the bigger picture? If we entered here, our average gain for these positions from point A to point B, this is at the peak before the current correction, our average gain based on the cost basis here and based on the closing high on a daily chart that occurred, I believe, on January 26, 2018, the average gain was 41.86%. And as far as core positions go in the master model, we still have this cost basis. We've not given it up. We haven't done any defensive sells of SPY since taking these entry points on 5/24/2016, 5/25, and in early June 2016. So when the market pulls back 10, 15, 20%, hypothetically, we would still have a healthy profit relative to this cost basis. But if we overreacted in here somewhere, that would not be the case today. So the longer you can hold on to your positions, the easier it becomes to navigate during normal and to be expected volatility. How can that be? If my cost basis is here, the longer I'm able to hold that cost basis, the bigger the gain that I have even at the monthly closing lows or at the end of the corrections. At the end of this correction here, at the monthly closing low, based on this cost basis, my gain would still be 96%. It's much, much easier to keep an open mind about long-term bullish outcomes when you're still sitting on a healthy gain. Conversely, if I was trading frequently in here and my cost basis was up here, I would have a substantial loss at this point here, which opens up an entirely different Pandora's box relative to investing and trading psychology. We would prefer to manage from a position of strength if the market allows. The psychology and the cost basis doesn't change anything that we do. As always, the model, the hard data, and the facts will determine when we classify something as volatility to respect. But the psychological component of investing cannot be understated relative to its importance. Anything that you can do to help you keep a clear head and stay with the long-term trend that could last several years, including trying to hold on to a low cost basis, is 100% worth it. All right, back to the present day, March 1st, 2018, over here with SPY. These gains here in this analysis is position specific. We're talking about one position in our portfolio, SPY. However, even the positions including tech that we took in May of 2017, the same concepts apply. When we get to this point here, we have a healthy gain, and even to this day with our core positions, 0 trades between point A and point B. So very, very similar to the cost basis back here for SPY. If we can make it through this correction and we're still in a bull market, that implies that a higher high is coming above this high here, which means these profits for this position and these positions will be higher. How do we know that we're going to make a higher high? That's what bull markets do. Bullish trends are a series of higher highs and higher lows. So the further we can get away from these entry points, the better from a psychological perspective, and it will allow us to focus on the primary task or primary goal, which is to try to navigate between a point A and a point B that could still be several years down the road. Definitely within the realm of reason that it could happen in 2022 or much further down the road based on the chart patterns today. And it's in the realm of reason that the S&P 500 could hit 7,400. No predictions, simply a probabilistic statement based on the facts in hand. Remember, we said the purple box here on March 1st, 2018 is similar to the purple box here in late 1996, early 1997. As we've mentioned before in this video, typically a useful signal or indicator can help you get in, as it did in 1995. The box is similar to the present day, and hopefully it should be able to help you get out as well. Eventually, we get the reverse. Much like black ADX, Bollinger Bandwidth rising from low levels doesn't tell you about direction. It's about volatility. The direction comes from the confirmation or closing above the upper Bollinger Band. It can work the other way. We can get a bearish signal. Early 2001, February 28th, 2001. The beginning of the dot-com bust. The stock market doesn't bottom until October of 2002, and realistically retests that low, so it really doesn't bottom until the spring of 2003, almost 2 years later. We get the reverse here. We know that 1995 had a low Bollinger Band. Therefore, this is another low Bollinger Band reading. It's turning up from low levels, and this time the price surge or confirmation happens in a bearish manner. We close below, at the end of February 2001, the lower Bollinger Band. The lower band's at 1245. The monthly close is at 1239. What else can we learn? Unlike the present day, March of 2018, or this period here, or even here, at this point, the market's not strong enough to close above the band, telling us that things are getting a little weaker from a conviction perspective here relative to here, here, and here. Another yellow flag. Price never gets anywhere near the center line here for Bollinger Band until this correction in 1998. Think of this somewhat as our Coke machine being rocked back and forth. It doesn't go over here, but it's telling us that this market is a little more vulnerable here than it was at any time between this point here and this point here. We see a sign of strength here, and notice after this sign of strength, we still rally into the spring of 2000. But after that, things look different. Remember earlier we said a strong trend can walk the upper band and touch it numerous times. Touch it, above it, touch it, above it, touch it, above it. This looks different here. Now, 1, 2, 3, 4, 5 times, right up until the peak of the bull market, the major peak, we have white space between the Bollinger Band, upper Bollinger Band, and price. That's quite a bit different than this entire period here. This is a sign of a waning trend, and we're moving closer to that trendless, sleepy market. Bollinger Band gets low, trendless, sleepy, low volatility. We're more in a range here. So let's compare these yellow, orange, or red flags to the present day to sum up. Number one, price here. Before really, really bad things happen, price closes below the lower band. That looks quite a bit different than anything we saw between 1995 and the spring of 2000. Number two, we failed to close above the upper band at some point. There's white space above the upper band that we covered. We tested the center line here. We're below the center line here. And the center line, unlike this entire period here, is rolling over. So we have 1, 2, 3, 4, 5, 6 things that we could see on this chart. Really 7 and 8, because this is turning up and this is actually considered to be a confirmation signal when it closes below. How does all of this compare to the present day? Do we have any of this telling us that the thought that markets could rally for years, that something might have changed in a negative manner? If we look at the exact same monthly S&P 500 chart with the exact same Bollinger Band settings, we do not check any of these bearish boxes in the present day. We're nowhere near the lower band as we were in 2001. This really doesn't look anything like this peaking process that took a long time and doesn't even look remotely close to any of this here. And this, a breakout above the Bollinger Band, in the Bollinger Band, close above and back in, looks a lot like this period here, where stocks rallied for an additional 1, 2, 3+ years. And that's a big gain between 750-ish on the S&P 500 and the peak up here above 1,500. Based on the facts that we have in hand, there's no yellow or red flags telling us that any of the analysis that we've covered over the past 18 to 24 months from a bullish perspective has changed in a meaningful way. Obviously, this is a very long-term time frame, telling us that we don't have evidence that this has changed, the uptrend here. What happens if we get a little closer and look at shorter-term time frames? March 1st, 2018, these are our 100 to 290 generic and for illustrative purposes only moving averages, helping us understand trends on multiple time frames. The present day still looks a lot like this period here. It really doesn't look anything, not even remotely close to late 1999 or in the year 2000 as the market's peaking. Stock market peaks here in October of 2007. Look how close the moving averages are starting to get in here. We've got evidence here of moving averages moving sideways, and then we get into this tight cluster look, which really doesn't look anything like March 1st of 2018. Blue, the fastest moving average, is still on top. There's white space between all of the moving averages, which is quite a bit different than this look here. And since the charts are considering all topics on all time frames, if we wanted to insert the what about tariffs in one of these blanks, our answer would be the market is well aware of this topic, and if it becomes a problem, this chart will begin to morph into something like this or this. Could that happen? The answer is absolutely positively yes. The analysis would be the same for whatever concern we can plug in or put in these blanks. We know it could happen, but we don't anticipate that. These are the facts that we have in front of us today, and we simply ask, are we allocated properly? Based on the model readings on March 1st, 2018, if the answer is yes, as it is today, leave it alone. If the answer is I'm not sure, leave it alone and give the long-term secular trend the benefit of the doubt. At some point in the future, the answer will be no, and it will require some incremental defensive action. When will that happen? Have absolutely positively no idea. We're going to take it day by day and remain open to all outcomes. Maximum flexibility does not relate to the look of this chart. We can feel confident about this chart, what it looks like, and what it's telling us about the probability of good things happening relative to the probability of bad things happening. We have to emphasize the probability of bad things happening, even with a chart like this, is never zero, ever. Maximum flexibility speaks to the fact that when we wake up tomorrow, we do not assume that this chart will look like this going forward. We take it day by day and continue to go through the same flow chart of questions. Based on the facts that we have in hand, Bollinger Band analysis, the long-term uptrend remains intact. The moving averages that we just looked at, the intermediate trends remain intact. As we noted on February 6th on short takes and February 13th on short takes, the post-waterfall plunge script tells us to be open to a much more difficult and psychologically challenging market, even under bullish circumstances. Price doesn't clearly start to move higher after the 1987 crash for 13 months. And it's within the realm of possibility that we retest the low or make a lower low even under bullish circumstances. This is a volatile box, orange box after a low. 1998, retested the low. 2 months later, this is an orange box with very high volatility. This is basically a trading range. This is basically a trading range or consolidation. In the shorter term time horizons, we're in a 100% normal and to be expected consolidation pattern for now. Is it possible we break to the downside? Sure, it's possible. The data that we have in hand does not support that conclusion, but we'll continue to take it day by day. Similar situation in 2011. Not surprising at all. High volatility, a lot of confusion, very, very difficult in here. Eventually, the bullish trend reasserted itself and prices went on to make much higher highs over the next 2 to 3 years. None of this is a prediction, but after writing about this 2 to 3 weeks ago, so far, we're within the normal bounds of what to expect here. We're inside of what could be a volatile box that could see us make a new low. What would change the shorter term probabilities is if we exceed this low and continue to move in this direction for an extended period of time. The math will take that into consideration, and that would be reflected, and eventually somewhere down here, we will switch to volatility to respect, which will require some incremental defensive action. And we'd like to, if possible, keep cost basis information that we have from 2016 and 2017. We don't want to get too careful about not risking our gains because we're trying to extract a large profit and navigate to a point B that could be several years down the road. It may also be worth a visit to the new website to see the FAQs We've got new and expanded FAQs covering traditional investing, low-cost passive investing, and the online/robo strategies that are currently in vogue. The material in this video has no regard to the specific investment objectives, financial situation, or particular needs of any viewer. This video is presented solely for informational purposes and is not to be construed as a solicitation or offer to buy or sell any security or any related financial instruments, nor should any of the content be taken as investment advice. Any opinions expressed in this video are subject to change without notice, and Shavako Capital Management, LLC, or CCM, is not under any obligation to update or keep current the information contained herein. CCM and its respective officers and associates or clients may have an interest in the securities or derivatives of any entities referred to in this material. CCM accepts no liability whatsoever for any loss or damage of any kind arising out of the use of all or any part of this material. We recommend that you consult with a licensed and qualified professional before making any investment decision.